Hello, everyone. Thank you for joining us. My name is Brian Donovan. I work in marketing and investor relations at Schulte Asset Management. Welcome to our investor webinar for the second quarter of 2024. I'm joined today by George Schulte, founder, managing member of the fund, and also Dean Crowder, head of business development. We are all looking forward to talking to you about the second quarter of the year here today with you. Today, we're going to discuss some recent events in the market, significant updates within the fund, as well as a broader outlook for the rest of the year going forward. Before we begin, I just want to remind everyone that this webinar is for investors only. So if you're press or media, please sign off now and contact us directly at investorrelations@samco.net. We will be taking questions at the end of this presentation. If you'd like, you could either type them into the chat box or the Q&A section below, and we will get to them at the end of the presentation. I'll thank everyone again for their time today, and we will get the presentation up and running here.
There we go.
Sick.
Excellent. Okay, Brian, well, thank you very much. Thank you all for taking time out of your day to hear what we're going to call a wonderful session for your investment portfolio. Our performance is superb, and I think today you're going to find out why. Brian, if you can pop me over to slide number 3, I'll kick it off here.
Yep, 1 second, just getting the right.
Okay. There we go, right there. So this is our big statement. We've got two in the slides here. Many of you have already seen this a number of times, but we're calling what we do now at Schulte one of the most opportune times for event-driven investing ever. In fact, George is calling it perhaps a once-in-a-generation opportunity. And we're seeing interest from all over the world. In fact, today we've got registrants from Europe as well as throughout Asia, US, of course. We're really excited about what we're doing because this is the moment. As you know, and what we've said before, every strategy for investments, no matter what it is, has its day where it's just performing as planned, it's running on all cylinders, delivering the performance that's expected and hoped to be delivered in the portfolio. And then there are other moments of real challenge where the returns are just not there. There could be volatility. There could be issues that are unexpected. This is the moment for what we do in event-driven opportunities. There are so many different challenges to companies out there affecting the way in which business is done. And those challenges for what we do in our strategy make this an exciting moment for what it is that we do. So why don't we go to the next slide, Brian? And some of those changes that are affecting companies, you know very well because they're impacting you and just doing life. Inflation, secular change is a big one. Interest rate policy, introducing AI, which we speak to every once in a while. These are really transforming companies in the way they do operations, particularly for those companies that enjoyed the benefits and jumped all in, financing their businesses at very low interest rates. Many of those interest rates are rolling in to be refinanced, and those are some real challenges that the companies are facing right now. Macro changes throughout the world, wars, rumors of wars, things that are happening at rapid succession can all lead to dislocation affecting companies, and this is a strategy that benefits for that. So again, to summarize our wonderful statement, for what we do in the event-driven strategy, this investment opportunity will be extraordinary. So let's look at the executive summary. You may not be able to see this very well, and I can't either. So forgive me for looking at some of my notes here, but I'm going to take it from the top. And this will be emailed, this deck presented today. Brian will get it out to you so you'll have it to go over in detail. And also he'll give you access upon request to our fancy data room where you can really get granular in all the things historically of Schulte and what makes this opportunity so special. So right off the top, year-to-date fund up 21.2%, beating all the benchmarks across the board for the first half of the year. We outperformed the Bloomberg measurements of their event-driven and their distressed debt hedge fund indices. That's our peer group. And then the broader market indices as well that Russell 2000 was up 1% for the first half, S&P 500 up 14.5%, and the NASDAQ up 18.1%. So beating our peers as well as the major indices, which we're extremely pleased about. Where did that come from? Well, second quarter was driven largely by appreciation in event-driven stocks and partially offset by some losses in distressed loans and bonds. So we've got a very balanced portfolio, mixed in its approach, and because of that, delivering the returns that you come to expect. Again, the outlook, let me hit some of the highlights here. Facing challenges because of the things that we've outlined. And what does that lead to? Well, too much debt is a bad thing, as you know, and can lead to bankruptcy, which is what we are focused on, companies that get into an extremely challenged situation. What makes us different, and we're going to hit on this again and reiterate exactly what makes Schulte different. We're nimble. We invest early. We're in there before, during, and after the distress cycle. We're looking at the entire capital structure of a company and entering into those opportunities, both long and short. We short companies early on and get a look into seeing exactly the opportunity set, what's going to happen if this company just doesn't make it. And through that restructuring and sometimes some light activism with our investment team, George has done this extraordinarily well over the last 26 years. We take an active role in making suggestions on the board and approach to taking what was once a great company back into a new opportunity. So a very exciting approach to markets in the way that we do things. Doing it much differently, I would say, than our peer group, and we'll get into that a little bit more here in a minute. Hit some of the measurements here that I think you'll be interested in. We're very satisfied with the fund's overall ratio of winning to losing investments. Second half of the year, first half of the year, second quarter, up 1.19%, winners over losers. Despite the gains of the long portfolio, we believe they're attractively priced as by the measurement of the TEV, the total enterprise value divided by the EBITDA, earnings before income taxes, depreciation, amortization, which you know, is a multiple measurement of 4.26 times. And our short book TEV over EBITDA of 51.46%. So when you take all those metrics together, these metrics compare very favorably to the S&P 500 index, which is the broad measurement, as you know, widely quoted, of 15.57% or times as that metric. So Brian, why don't you take us over to the next one? And I'll actually have to point out some things here because I know you can't see it. But this is a great illustration, and visuals can bring even a greater impact to what we're doing here, why we're calling this one of a once-in-a-lifetime, once-in-a-generation, I should say, opportunity for event-driven, extraordinary times here. This is a chart of Schulte Partners LP versus the Bloomberg measurements, the event-driven and the distressed debt index. The timeline on the bottom is about 4.5 years or so. And as you would expect, the green line at the top is Schulte, handily outperforming all three of these measurements. The next line down in the purple is the S&P 500, which we beat quite handily. The next one is the Bloomberg Peer Distressed Debt Index in the blue. And in the bottom are our direct peers in the hedge fund space in the orange, which we outperform significantly. So a very impressive visual to point out there. We've done this over the last 4 years to include some of the other broader measurements outside of Bloomberg, HFR as well. And it's crucial to have an edge and focus on the competitive advantages. And here are some of those that we've come to deliver and want to reiterate during this call. One, you've got to have a well-defined process with superior risk controls. We have those in place. We eat our own cooking, so to speak. A large percentage of the assets under management are part of the principals as well as the employees of the firm. So risk control and protecting principal is paramount to what we do. A lot of experience in managing volatility, and all of those lessons learned are now fully incorporated in what we do here at Schulte. Our shorts underperformed, but we cut our losing positions in the first half of the year and redeployed that capital very quickly and got it back into positions with new opportunities. So we're not taking capital away from situations where companies are under the microscope, maybe in and out of positions, but we're redeploying that capital, make sure it's actively involved. One of the things that we hold to here that you may not hear touted with your other investment managers, but it's a reality. The best investors generate most of their gains from a small number of investments, but you still want to be broadly diversified because no one knows exactly when those investments are going to deliver the returns that you've got. So very cautious, but yet very focused on what we do in delivering the alpha that you come to expect here at Schulte. So that being said, I'm going to turn it over to George here, and he's going to talk about the second quarter market review and outlook. George?
That's great, Dean. Thank you. And thank you, everybody, for dialing in this morning. Dean, you said all those things much better than I could have, so I really appreciate you walking people through it. Looking at slide number 7 here, overall market review and our outlook. On the macroeconomic front, it's a changing environment. As we say in our quarterly letter, and that this deck is really a summary of the quarterly letter. But the economy, the U.S. economy, is chugging along. You know, we have growth of about 3.1%. CPI is still a little high at about 3%, and the unemployment rate is still pretty low at 4.1%. As a result, the Fed has the Fed funds rate, the policy rate, at a midpoint of 5.375. And you continue to see monthly rounds of quantitative tightening, but there have been some adjustments to that. So M2 money supply actually year over year just grew a little bit. But we are in an environment now where you have contractionary monetary policy. For those of you who heard the Fed speak yesterday, it's all over the news this morning as well. It's pretty likely now that we should expect Fed action by September, by the end of September, but it is difficult to predict. The Fed is very data dependent, and things can change between now and then. And at the same time, inflation is above their 2% target. Also, and some reporters were asking Jerome Powell yesterday during his press conference about this, but it's pretty clear that the Fed wants to stay out of politics. They don't want to appear to influence the election in one direction or another. So we shall see. But most likely there will be some Fed action by September, and that'll be consistent with continuing slowdown in the growth of the economy and potentially CPI tamping down a little further. On the fiscal policy front, you still have a pretty concerning picture. You have massive deficit spending in the U.S. that's likely to continue no matter which candidate wins the presidency. I mentioned quantitative tightening. That's really monetary policy, but we have it in this section. But that is slowing the economy. And most economists who follow the Fed's policy have expected previously a much more near-term reduction in the policy rate, and we haven't seen that yet. Having said that, the economy is still chugging along. So what are the investment implications of this environment, and what's changing and what's likely to change? You have a big election coming up later this year. There'll be a lot of back and forth about how policy may evolve due to that. But corporate borrowers, and Dean was alluding to this in his opening remarks, are facing a very challenging environment. The cost of servicing debt has increased dramatically. You've seen all sorts of secular change, mostly driven by technological innovation. And then, of course, inflation is negatively impacting most businesses around the world, as well probably most individuals. So what do we do? What do we recommend? We recommend avoiding canned approaches to portfolio management. You get what you pay for. Don't necessarily just throw all your money at ETFs and try to pay a low cost and then maybe suffer from the volatility or the uncertainty that comes with that. Rather, we think it's a good time to focus more on short selling stocks that are facing fundamental issues like too much debt and an inability to potentially refinance that debt. And on the long side, you can stay pretty nimble in this market environment, and you can really focus on attractive event-driven securities. That's what we've been doing. It's working well, as you can see from the performance. We like post-distress stocks, companies that previously restructured and have clean balance sheets. We also like some opportunities in distressed debt. That's a developing and growing opportunity set, and we think there'll be more and more of that going forward. Let's turn to the next page, please, Brian. So
You want
here's
me
how
to
the
jump in here,
distress.
George? You want to get that one?
Sorry.
No, you're gonna jump in here. You want me to grab this one?
Oh yeah, please go ahead, Dean. And why don't you kick it back to me after this slide? Thank you.
Yes, exactly. Okay, so here's another illustration, very powerful. This is one tool that we use, and you've seen it on all of the webinars and in our pitch deck as well. The beginning of a new distressed debt cycle. What does that mean for us? Well, when you examine this timeline, it starts on the left side, December of 98 through the very end on the bottom says December 23, but actually the numbers are through June of this year, 24. What it's showing is the actual default rate of bonds and loans over that time period. The large spike in the middle, of course, is the great financial crisis. And in the far right there, you can see the COVID situation where literally the world stopped at that point and it was off and running again when all the barriers were lifted to the way in which business was done. And that's introduced inflation and some of the other challenges that we've dealt with. But what's this showing us now is we're now in a period as measured as the fourth largest default period on record, certainly illustrated here. And that says a lot because we believe we're in the beginnings of that stage, that we're going to see a lot more of this and to also accelerate. So that's a good thing for what we do. And even though we're not completely focused in the debt instruments, as many of our peers are, certainly the larger event-driven distress shops out there are not even trafficking in equities, neither short selling or going long. They're right up the middle with the restructuring of the debt, which can lead to some challenges in the environment that we're in. We think that this opportunity now for what we do is going to open up the floodgates to new event-driven prospects going forward. And again, what I had said earlier holds for what we do, and this statement that we're saying is pretty dramatic, that this could be one of the best opportunities we've ever seen on record. What does that mean for your investment portfolio? Well, you're going to benefit from that experience, from what we know and how what we've done over the past years in all sorts of market environments on record, some of the most challenging. But knowing in full that every one of these strategies that you can take a look at, and it's tilted now toward private equity, private capital, private debt, private venture. I mean, everything is private. The focus on having a liquid portfolio that can engage the environment that's present and developing, we think is extraordinary. So, George, take it away. I'm going to turn it back over to you.
Thanks, Dean. Yeah, good points. Here on the distress trends and industries that we currently see that have distress and drivers that are powering the distress. As you can see, it's a long list and it's growing. The big takeaway these days are those three things we talked about: inflation, higher interest expense, and secular change. But just going down the list for a moment, in the airline space, we've been looking at Spirit Airlines, which has risk of bankruptcy in the near term. Boeing has been all over the news. I mean, that company is probably too big to fail. But there's a change at the top that was announced just this morning. Automakers, companies like Stellantis and GM are dealing with massive secular change and managing it quite well. But there's a lot of challenges to their business plans. On the coal front, a lot of post-distress equities. Companies like Alpha Metallurgical Coal, which was a great performer for our portfolio in the last couple of years, and Peabody Energy is another similar company that's more focused on steam coal. In the crypto space, a lot of new opportunity. FTX was the biggest crypto blow up ever. I think they're calling it Cryptopolis. But companies like Coinbase and even smaller companies like Celsius, which recently restructured as a crypto Bitcoin mining company, present some interesting opportunities. On the energy front, you have a changing dynamic. You have geopolitical uncertainty now, with risk of war increasing ever more, and the price of oil and also natural gas moving up on the longer term front. So companies like Chord Energy and Chesapeake Energy are positioned well in that space, we think. In entertainment and media, it's really about secular change, but there's a lot of distressed debt because of that. So companies like Diamond Sports, which own the regional sports broadcasting rights across the country, are going through big change right now. On financial services, companies like New York Community Bank and First Citizens, those companies are benefiting from having made attractive distressed bank acquisitions. At the same time, companies like Valley National Bank are positioned pretty poorly still because they have unrealized losses and substantial commercial real estate exposure that hasn't really necessarily been marked down sufficiently. In the gaming and leisure front, just yesterday, Caesars reported earnings. That company too is seeing secular change where more and more people are going to online gambling, and Caesars is benefiting from it through its digital platform. So there's really a lot going on in this, in different industries, in healthcare and litigation due to mass torts. You see companies like Endo Pharmaceuticals and Mallinckrodt. Mallinckrodt actually just went through its second bankruptcy. But big companies are affected too, like Bayer and Johnson & Johnson and 3M, dealing with mass torts. So it's important to have, I think, a legal set of glasses when you look at some of these companies and some of the restructuring issues to think about how that's going to play out going forward. Real estate, towards the bottom of the list here, I think that's sort of, ground zero for, the cycle that we're entering and the cycle that we're already in. There's underwater commercial real estate all over the place. So companies like Office Properties Income Trust, Marcus Millichap, Anywhere Real Estate, WeWork, they're all emblematic of that change where more and more people are working remotely. Real estate was financed and underwritten during the great fixed income bubble when interest rates were so low that cap rates were so low. And of course, now you're seeing that all change really in quite a dramatic way. So there's a lot going on, as you can see. I could talk about it all day, but why don't we move to the next slide and we'll talk about recovery rates now in this cycle. As you can see here, and again, apologies for the font being so small. I can see it well on my screen. Hopefully you can too. If not, when you download the report, it should be more visible. But this is from JP Morgan as well. It shows on the right-hand side the chart what the recovery rates have been for high yield or junk rated bonds year by year going back to 2008. As well as first lien loans year by year going back to the same year. And you can see at the bottom of the chart, or if you can, I'll explain it to you. Recovery rates have dropped a little bit in this cycle. They used to be much higher, but that also makes sense because underwriting standards really went out the window when the fixed income market was in such a bubble and interest rates were so low that you had the lowest interest rates in the history of the planet. And so now, it's really important to work with an experienced distressed securities manager who's seen lots of cycles and knows how to avoid the pitfalls of walking through this minefield. There are a lot of companies that are bad companies that don't deserve to exist. And so you'll have to do fundamental and detailed research to look through that minefield and find the good businesses that are trading at a cheap discount, but still have good prospects after they restructure. So it's an interesting change in this cycle. Brian, let's talk about the portfolio overall for the second quarter of this year. Dean already mentioned the performance statistics. We're trouncing the indices, not just our benchmarks, but also the broad indices. So we're very proud with that. In terms of our win-loss ratio, yes, we did pretty well with the portfolio, 1.19 times winners to losers. That's pretty good. But I think we're particularly a little bit more proud of the post-distress equity bucket in the portfolio, which is most of our exposure right now. In that bucket, we had a 1.65 times win to loss ratio. Short stocks didn't do so well. It was 0.63. We were losing some money in the short book, and as a result, we realized a lot of losses there. We took our lumps and sold or covered those positions, and that's good because it generates tax losses for our taxable investors. But as Dean said before, it allows us to redeploy that capital to things that are working well. And some of that might have been a little bit of a macro market rally that we saw during the second quarter. But we're happy with where we are positioned right now. We're pretty nimble at about 102% portfolio invested right now. So we have dry powder to look at new opportunities, but we think the opportunity set really is growing. In the next couple pages, we'll talk about a few of the main drivers, a few of the noteworthy positions in the portfolio. But just to summarize, and there's more detail about this again in the quarterly letter, our best performers during the quarter were securities issued by McDermott International, Vistra Outdoor, Windstream, and Overseas Shipholding Group. And our worst were positions, securities issued by Stellantis, Grayscale Bitcoin Trust, Diamond Sports, and National Cinemedia. Let's turn to Overseas Shipholding Group as the first one to discuss. This was a post-distress stock, 3% portfolio position as of the end of the quarter. Nice IRR. We generated 30% gain on it during the quarter. This company, by way of background, it's an energy transportation services company that delivers crude oil and petroleum products throughout the world. It was founded in 1948, and it owns and operates a fleet of 21 barges and tankers. And they operate mostly in the Jones Act trade, which is U.S. to U.S. Ports. They also have some non-Jones Act barges, but their focus is really Jones Act. Now, we've been involved with this company for over a decade, actually over 13 years, going back to 2011. Back then, we were short selling its old pre-petition stock. The ticker symbol was OSGIQ. And that stock eventually became heavily diluted when the company finished its bankruptcy plan in 2014. And it's interesting, what caused the bankruptcy back then. The real driver for Overseas Shipholding Group having to restructure and go through that long and terrible bankruptcy was an IRS penalty. It had a $256 million penalty from the IRS, the U.S. Internal Revenue Service, for unpaid taxes due to the way they repatriated foreign earnings, and I think they basically got some bad advice on how they structured one of their loans, and that's what caused it. So that company restructured back then in 2014. It eliminated nearly $2 billion in liabilities, and that post-petition stock issued by OSG performed pretty well. But then it had another event. It started to drop sharply again after COVID. Fortunately, OSG had a great management team. It was led by Sam Norton, who we've come to love and know well. Management did the right thing during that time. They put a number of vessels into layup, and they also refinanced the company's term loan, which was facing an untenable maturity. And at the same time, they executed on several distressed vessel acquisitions, which gave them a broader scope of operations. And most importantly, I think at the time, OSG started to lock in longer-term charter commitments. And as the market recovered, you saw a business that started to have very steady and visible future cash flows that were growing. Ultimately, that led to a bidding war to buy the company. There were a number of bids that surfaced, and finally, the company was sold at $8.50 a share just this past July after an extensive M&A process. So what are the takeaways with OSG? I think it's a great case study on how to do this post-distress investing trade well. Of course, too much leverage can damage any business. I think it's probably become obvious for those that have spoken with us and followed us for years. And I think you can figure that out by looking at the list of industries and themes that we're looking at these days. But management is also very important. If you have the right management team, that'll be crucial during, not just the restructuring phase of investing in distressed and event-driven companies, but also afterwards. If you get hit with a curveball like COVID or something else, having the right management team to execute on that is so critical. Obviously, don't cut corners with taxes. Maybe that's just too obvious. But importantly, also, good things happen to companies, good companies that trade at attractive prices. There are lots of those right now. And because of that, if you find those that have interesting event-driven characteristics like M&A opportunities or stock buybacks or special dividends, chances are you'll be able to make pretty good money and generate nice event-driven returns. So in closing with OSG, it is sad to see it leave the portfolio. It's been a great, we've had a great number of trades with it, both long and short, but there's a lot of new opportunities and a lot of other opportunities in our portfolio right now. So we're excited about the future. Let's turn to Vista Outdoor. This is another very interesting one, a 4% portfolio weight in our fund, generated an IRR of about 23% during the quarter. The stock price for this company right now is at about $40.60. This company manufactures and markets sports products globally. It has two businesses. One of them has been renamed Kinetic and the other has been renamed Revelyst. And Kinetic is ammunition, hunting accessories, and tactical products, while Revelyst is more consumer-oriented products like bike hydration packs, bicycle helmets, skiing helmets, camping stoves, and other items like that. The Revelyst side of the business has a number 1 or number 2 market share for almost all the products it sells. So it's a great business. The Kinetic business is also good, but not that attractive for public shareholding investors lately due to ESG concerns. So how did we find this? We got involved with Vista Outdoor first starting right after it acquired Remington, which was one of the nation's largest firearms and ammunition manufacturers, with roots dating all the way back to 1816. Vista Outdoor purchased Remington's assets out of bankruptcy back in 2020, and that was Remington's second bankruptcy in several years. Vista got a steal of a price. They bought it for $81 million. And we were familiar with it because we had invested in Remington after its first bankruptcy. Back then, it eliminated almost $800 million in debt, but then it had trouble and went back into bankruptcy. And at the time, we actually tried to structure a purchase of Remington ourselves with our fund's former SPAC vehicle, but we failed because Vista outbid us basically just by paying cash. And so they got a great deal buying Remington for cash. Again, only $81 million for this, great business that's been around for, all the way back to 1800. So what's happened lately with Vista Outdoor? Our understanding of the situation is that the board and management has become very frustrated with the trading price of the stock. And so they've taken steps to enhance shareholder value, as they say, first by monetizing the Kinetic business, which is the ammunition and hunting accessories business. They agreed to sell it to a company called CSG Group back in October of last year for $1.9 billion. And under that original deal, they would pay off the company's remaining holding company debt, then pay a one-time special dividend of cash, almost $13 a share, to VSTO shareholders, and convert those remaining shares into Revelyst shares, which would get a new symbol, ticker symbol GEAR, or GEAR, to really represent what the company will be as a consumer products number 1, number 2 market share business going forward, and hopefully drive a lot of demand to own its new stock. Of course, that news drove big stock appreciation to Vista, and it eventually led to a bidding war as well, where there were multiple parties that showed up, including Colt, another company that sells firearms and ammunitions, as well as MNC Capital and some others. Because of that, the company was able to strike a new deal to increase CSG's original purchase price to $2.15 billion, and offered to give back a lot more cash to VSTO shareholders at $24 a share, which that deal appeared to be certain to go through. And just earlier this week, it was announced that due to shareholder feedback, the board is now going to reconsider that strategy and now take steps to potentially monetize the Revelyst business as well. So we're happy with all these catalysts. It looks like we'll probably win in either way. If Revelyst becomes a new publicly traded stock, we think implied by the current price of VSTO, it'd be very cheap, trading at about 4.96 times next year's EBITDA, versus other companies in the same industry, with similar brands traded between 8 to 12 times. If that doesn't happen and they wind up selling the company all in, we think there's a lot of upside there as well. So right now, this stock is trading at about $40 and change. Our target is closer to 50, which would be another 25% IRR on this position. And probably happen in the very near term that we'll know what the next events will be with Vista Outdoor. Thanks, Brian. Yeah, turning here to Windstream. This is a telecommunications company stock. It's long in our portfolio. It's a post-distress private stock at a 3% portfolio weight, which had almost a 60% IRR during the quarter. We also have a related position short selling Unity Group, which is a publicly traded real estate REIT stock, which is in a deal to merge with Windstream. So Windstream is interesting, because of a number of catalysts as well. As with OSG, we previously short sold Windstream, and so we've taken this, through all three trades before, during, and after bankruptcy. Windstream restructured back in 2020, and in that plan, it eliminated about $11 billion in liabilities subject to compromise. When it came out of bankruptcy, it came out after it settled ongoing litigation with Unity, and both parties, Unity and Windstream, had agreed to invest substantial amounts of new capital into their network assets. So what does it do? It's a communications company. It provides communications and broadband services to customers across 18 states. It also manages cloud communications, networking, security services, and for enterprises and governments across the U.S. Before Windstream fell into bankruptcy, it had spun off its network assets to a new company called Unity. And that was how Unity was originally formed. And then it leased back those same assets under a master lease agreement. But that original transaction, the sale leaseback, which is actually technically called a failed leaseback because of the way it was structured for tax purposes, the legality of that transaction was later challenged by bondholders. And that's what ultimately drove Windstream into bankruptcy, because they won a ruling that said that that was a fraudulent transfer. And so that's what drove Windstream into bankruptcy before it ultimately came out and eliminated $11 billion in debt and then settled that lawsuit that it had ongoing with Unity. So what's new with Windstream now? Again, this is post-reorg equity. It's private. There are markets that are made in it regularly. But just in April of this year, and it was pretty well telegraphed that this was coming. It was reported, on a number of news wires that they were looking to sell the business. But in April of this year, Windstream and Unity announced that they would merge again. So we're bringing these two sister companies back together. And under the deal, unit shareholders, which is the publicly traded REIT stock, they will own 62% of the combined company once the deal settles. And Windstream shareholders, including our fund, will own 38%. Or 42% on a fully diluted basis. So Windstream shareholders, even though they're getting less than the majority, they had pretty good negotiating leverage because the balance sheet was so clean after restructured. So they're also getting $425 million of cash and $575 million of preferred stock in the deal. And that preferred stock will have a nice coupon. I think it starts at 11.5%, rising to 15% over time. So that's good. So the combination will create a leading fiber provider with about $4 billion in revenue and 217,000 fiber route miles, covering 47 states across the U.S. So we have, again, a long position in the Windstream common stock, a short position in the Unity stock, and we like the way we're positioned because the entry price into the deal is less expensive through the Windstream common stock, which is currently trading at about $12 to $13 a share. And our target for that is about 16, which would be an additional appreciation from where it's currently marked of about 33%. And again, some of that, the equity part of the consideration is somewhat hedged with the short on Unity stock. There's also an interesting opportunity, another catalyst coming out of this deal, which is an opportunity to participate in the rights offering to help fund the closing payments that are owed to, I think it's mostly to insiders at Windstream. Under that rights offering, we believe our fund will get an opportunity to purchase additional shares at a pretty big discount to the deal price. So we're excited about that too. But I hope these examples give you a good sense of the types of deals we're looking at and the types of opportunities we found. As you can see, they're very idiosyncratic. Lots of upside if you find them and research them in the right way, and lots of events that can help drive future returns. Let me turn it back to Dean. Dean, I hope looks like you're back with us. I see that you had some communications issues, so I hope everything's going well. But why don't you take us through the conclusion here, please?
Yeah, thank you. And well spoken, George, on all the activities that we're doing in the portfolio. You and Gary, Julian, and the rest of the team are doing an outstanding job, and my hat's off to you in the success. Looking ahead, where are we here? Well, we've had a fantastic first half of the year, fund up 21.2% year to date. That's coming after an extraordinary year last year in 23, where we were up 26.8%. Our 4-year outperformance against our peers, our rolling 4-year compounding at roughly 19% or so, and then beating all the major indices that are the broad measurements of in the equity arena, Russell, S&P, and the NASDAQ. So we think companies are headed into extended challenges, with inflation still being a consideration, the interest rate environment still kind of uncertain, secular changes affecting across the board the way business is done globally. And the introduction of AI is going to bring some interesting means in which companies can compete in the arena economically. So a lot of things that are much different today than they were pre-COVID. What does that mean? Well, we think this is probably one of the best macro environments for what we do, and is only going to extend. When you combine these situations with too much debt on a company's balance sheet, it bodes very well for what we do in identifying companies that may be headed into bankruptcy. Our peers, other choices that you might have for investing in the event-driven space, typically are focused on the debt side of it. We do a little bit of debt. We manage that very effectively, but the equity, being nimble, shorting on the front end, and then going long if a company emerges and looks very promising on the back end. So doing things very differently, we think, is going to continue to keep our returns there, positioned well, and manage the volatility that kind of comes with it. We're nimble. We're focused on what we do best. We're not off doing other things that are outside of the bounds of the event-driven space. So we think that keeps us our excellence continuing on. But we're going to diversify your portfolio holdings. So if anything can be said about the benefits of Schulte, and you've seen where we are today and our beliefs in extending that, but based on our performance and what George and the team believe, it would make sense for you to add to your positions. That's a nice statement to say coming from the marketing guy, but I'm going to knock on your door and see if we can get you back in here for a larger holding. You want to pick and run with a winning horse. You don't want to take your winners and then give them to your losers and hope we can bring those back into the portfolio and all the dreams are going to be accomplished. No. You want to go with the winning horse. You want to go with the returns that are coming in with companies that are doing well, and manage those and trim them as they go, and then bring others on similarly to build out the portfolio. So to sum it all up, we're very excited. We're grateful for the business that you've given us. We'd like to grow the relationship, and any referrals, anyone that you think would benefit from our expertise in this very challenging environment and what's to come in the post-election arena, we'd welcome that opportunity. So I'm going to turn it back over to Brian. He's going to hit some of the performance here and shoot in any questions that you might have. We've got time for a couple questions here at the end. Brian?
Yep. Thank you, Dean. Well said. Just as Dean had said, quick track record of our performance here. Obviously, a reminder to anyone new, the fund's on a master feeder structure. We have Schulte Partners at the top, and then Schulte Offshore Fund, obviously, for our offshore investors at the bottom. You can see quite the track record going back to the 90s for Schulte Partners, and just fantastic, on the 4-year basis, especially the standouts, up 26.8% for 2023, coming off a great year. First half of 2024 up 21.2%. Like we had mentioned, just broadly outperforming all the indices, and just really happy and satisfied about that. Again, if you guys would like a further kind of view, that will be available on our data room. We have all of our monthly letters, audited financials, all of our quarterly letters dating back for many years. And that's a great way to get a good sense of more investment examples like George had gone through with us today. So one other quick thing to mention, events coming up for this fall. We actually have quite a few. On September 12th, we're actually hosting a lunch at the Union League Club in Chicago. So if any of you will be in the area or would like to join us, again, September 12th, Union League Club should be a great investor lunch we'll be hosting. We will send out some emails reminding you guys of that as we approach that date. And then also the Grants Fall Conference in New York City on October 1st. We will be attending that. And then finally, SALT iConnections in Singapore from November 11th through the 13th. We will be attending that conference as well. So we hope to see you there coming into this fall at any of those events. And if you aren't able to make it, the team would be happy to set up a meeting either in person if you're in the New York City area or via Zoom or Skype as well to discuss some exciting investment opportunities as we jump into the second half of 2024. So right now we're just going to open it up to Q&A. If anyone has any questions, feel free. You could type it into the chat box. You could type it into the Q&A section, and we will be happy to get to your questions. Let me just give it a check, see if we have any so far. We actually have our first question, which I think is very topical as we're finishing up the summer, coming into the fall of 2024. Someone asked, what is the impact of the oncoming election on a macroeconomic perspective, and how could it potentially impact the portfolio? I think that's a great question. George, want to give your thoughts on that?
Yeah, sure. Thanks, Brian. Geez, it's a crazy environment with the U.S. election. First it was Biden and Trump, and then the assassination of Trump, and now Biden stepped down, and Kamala Harris has stepped up. And the polls are swinging, day by day, so nobody really knows what's going to happen. It feels like right now it could go either way, and there's a lot of potential change depending on which party gets the presidency. However, probably more important is which party controls Congress, because sometimes if you have a split government, you can't necessarily mandate that much change, and so we'll see. Having said that, one of the things we like to look at, periodically, and we just did recently, is the overall fiscal picture for the U.S. And the quick takeaway from that is it does not look good. And with that, the U.S. government just has so much debt and other liabilities. If you add it all up, I think it's 130 trillion or so. So it feels like it really won't matter who runs the government, because they won't have much flexibility one way or another. And thinking about that $130 or 130 trillion in liabilities, the entire GDP of the nation is 28 trillion, and total tax revenue in the U.S. is between 4 and 5 trillion. That's 4 to 5 trillion versus 130 trillion in liabilities. And at the same time, so think of that as revenue, and expenses are much higher than that. The U.S. government has been spending 6 to 7 trillion a year. You have massive continuing deficit spend, and it appears that either party, whichever one wins, will continue that going forward. So I think the main takeaway when you think about politics in the U.S. is that it is an uncertain environment. You should probably stay relatively nimble in the portfolio. God knows what will happen between now and November. Hopefully it's peaceful. But there's certainly a need to hedge virtually every portfolio due to the risk of or against the risk of inflation, because we're just not going to be able to pay off that debt easily. So you're going to continue to see a steady depreciation in the dollar over the long term. And that inflation that you see will continue to impact businesses, just like we talked about earlier. So that's a continuing theme, and you should be prepared for it.
Definitely. Thank you, George. Well said. We actually have another question just came in. This one reads, what are the biggest challenges you guys see for the second half of the year that could affect the fund, and how is the fund going about mitigating these risks?
Dean, do you want to take that, or you want me to hit it?
Well, you're the guy. I think you're going to say it much better than I am. But I would say overall, from being positioned within the investment committee, I think our approach is very cautious. It's not just putting on positions and seeing the value realized. The short front end helps mitigate some of that volatility, but you're managing it very effectively and cutting positions and trimming during volatile periods, which I think that speaks very well for the lessons learned up to this point for a strategy that can sometimes be kind of lumpy in terms of its returns. So,
yeah, and I would add to it. It's a good question, but it does sort of make you think about all the things we just talked about in our slide deck, which are, you have inflation, you have secular change, you have excessive leverage. I mean, the leverage, now that we think about it here on a macro, basis as well as a micro basis, there are lots of companies that have too much debt, but it goes all the way up to the federal government as the biggest borrower in the world. So that's a systemic risk. I think that's a challenge. Commercial real estate, as I said earlier, when we talked about industries, that's ground zero. It's going to continue to be ugly in that space, and the impact that might have on banks and non-banks as well, private credit lenders and others, we'll see, remains unknown. I think it's a big risk, and as that changes, I think you could see, systemic fallout maybe in the markets overall. So you should certainly try to hedge your exposure in every portfolio for market risk as well as inflation risk. So I would say stay nimble and expect the unexpected.
Definitely.
Yeah.
Well said. And I believe this last question kind of ties in with what we had just touched on. But going off the fund's great performance on a 4-year basis, what makes you think it will continue going into the rest of 2024 and beyond?
I'll take that one, Dean. So it's a tough question because most investment strategies that outperform eventually revert to the mean, and I think we're subject to that risk as well. However, I take comfort in the fact that there's a lot going on behind the scenes with our portfolio. We're not blindly buying positions and just waiting to see what happens and waiting to run them back up or down. When things change, we rotate out of positions. If they hit their high watermark risk guideline, which I think is one of the best risk guidelines we have in our strategy, we move them out of the portfolio and move on to other opportunities. So we're truly doing what Dean described earlier, which is we're letting our winners run. When they start to turn around and go in the opposite direction, we're taking profits and moving the capital to things that are working. And for things that start out by not working, we're cutting them pretty quickly. So I think that it's not perfect, but it's I think a great simple way to manage a portfolio wisely and helps get you through the risks of doing dumb things as a human. I think our team approach helps, but there's no guarantee that we'll keep generating market-beating returns. But I'm really also optimistic about the values and the trading levels and valuations of the things we own on the long side, as well as the things that we're short on the short side. Plus, just one final comment from my side. I don't know if Dean, you want to add anything.
Yeah.
But the events behind these positions are extraordinary, and when they kick in, things like Vista Outdoors, potential tax distribute or cash distribution, or maybe just sale of the whole business. When they hit, they tend to be lumpy, and usually it's on the upside.
George, I think you're too humble and modest. I mean, some of the winners that you outlined this morning had enormous returns. And those are still being extended through the process of managing the holdings as well as monitoring the companies as they reemerge. So I think it's only going to continue, and many other opportunities are going to come to the forefront. I know Gary's been bringing a lot, as well as others, to the committee for review. But there are a lot of opportunities, and this environment is only going to bring more. So this is a great opportunity for people who are involved to add to their positions.
Definitely. Well said. Well, that wraps up our Q&A. Want to thank everyone for joining us today, and thanking those that will be watching this via the playback in our virtual data room. Do want to say have a great rest of your summer, and we all look forward to updating you come the fall for Q3. Any closing comments, Dean and George?
Only thing I was going to say is, again, thanks for participating with us through this wonderful journey. Any questions, anything you need, shoot them into Brian or myself, and we'll coordinate an answer straight away from the team.
Yeah, from my side also, thank you to everybody who dialed in, and please don't hesitate to call me directly as well. Look forward to working with you, and like Brian said, enjoy the rest of your summer.
Thank you, everyone. Take care.
Thank you, everyone.